Bob, there's suddenly a lot of talk about a 70% marginal tax rate on incomes of 10 million or more in the United States. A couple of very smart people here have called that a disaster and scary. Is that something we should actually be worried about?
Well, I don't think it would be good, but mostly I don't think it would solve any problems. I mean, the reason that that's emerging as a topic is because of populism, income inequality, and though populism and income inequality are really rooted in much deeper issues that tax rate, a 70% tax rate, is not going to address. You really need to have jobs and incomes in the parts of the country that have been gutted by one force or another. And so largely the forces of populism are much more powerful. They're not going to be really addressed by that kind of a shift in the taxes. I think the one thing that it would do is it'd help with the deficit, and that's worth mentioning because, given the fiscal stimulation last year, we're running a significant deficit right now, about 4% GDP, and one of the elements of that people haven't really paid much attention to is that when you consider the size of the deficit, the growth rate in the economy, and the maturity of the debt, in just a few years, the debt rollovers are going to be substantial, and the gross issuance of treasuries is going to be running around 25% of GDP or higher. So literally 25% of GDP issuance of treasuries every year. Normally, people don't pay much attention to that because you assume that the debts are going to be rolled over. But the interesting element of that today is that so much of the U.S. Treasury debt is owned by foreigners, and so much of it is owned by central banks and countries where we have some element of conflict, that it's an element of a lever that could be used. And so you don't necessarily assume that you're going to roll over those debts. Now, if you don't roll over your debts, that's when you have major problems.
And Bridgewater's done exceptional work on history and historical precedents. How is that situation likely to get resolved?
Well, if you were a foreign investor, you'd be looking at that pile of debt that's coming at you over the next 10 years and probably wouldn't be too excited about owning it, which makes matters worse. And so the pressure can come one of two places. The pressure can come from the interest rate side, or the pressure could come from the currency side. But either way, the present value effect of either a higher bond yield or a lower currency means that kind of 10-year forward currency is probably not something you want to be holding. So while in the short term, the pressures on the dollar are still relatively positive because the U.S. economy is outperforming, there's this long-term question mark related to the dollar, partly because of those pressures.
And what triggers a problem? Is it something that just sort of gradually we're likely to have higher and higher interest rates, or do we just cruise along and people talk about the debt for a while and then suddenly something happens and it becomes a crisis?
It depends on how well the economy's managed. If the economy is well managed, the economy's growing, then you have the capital inflow. If you manage your political relationships well, then you don't have the conflict and you don't have the threat that presents. So it really comes down to leadership. It comes down to economic conditions, economic growth, and you can't predict it that far out. But that sort of a latent situation is just something to register as something that could be an issue down the road.
And Bridgewater, Ray Dalio has talked a lot about how we may be in the 7th or 8th inning of what he describes as the debt cycle, another topic that Bridgewater's done great work on. Do you still think that that's the case? Is that about where we are? And how does it end? What happens after the 9th inning?
Well, we think we're at a key juncture right now. If you get a running start on the current situation, we had a severe deleveraging in 2008. We've had the printing of money. We had 10 years of nonstop monetary stimulation. Zero interest rates was not enough to stimulate the economy because of the debt overhang and the pressures of deleveraging and deflation, and that required quantitative easing. So you had 10 years of zero negative interest rates, quantitative easing, which inflated asset prices, drove yields down, was great for asset markets, got really a moderate growth rate out of the global economy given that degree of stimulation. Nonetheless, 10 years of growth, and now roughly, let's say a year and a half ago, then central banks started to contemplate tightening, and then this year they have tightened. So we're now 12 to 18 months into a tightening cycle where the Fed first starts rolling down the balance sheet, they start raising interest rates, the ECB stops buying bonds. We had macroprudential tightening in China to take some of the leverage out of that system, which is now creating knock-on effects through that economy. So we are kind of 12 to 18 months in post-tightening. Typically, monetary policy leads by about a year, and so it's not unusual to get a slowdown now. But at the same time, we're on the backside of fiscal stimulation in the United States. There was a real pop from the fiscal stimulation, but that's like a shot of adrenaline. You get it, and then you get on the backside of it, and it actually slows things. So the fiscal is rolling over at the same time as the monetary is taking effect, and the tightening in liquidity has pushed risk premiums up, created a little bit of a correction in the stock market, the dollar's up, yield curves flattened. It's all very classic in terms of what a turning point typically looks like. And so 2018, that whole configuration affected the markets, and we think in 2019 it'll probably affect the economy. The question is really how much. And the most interesting question pertaining to that inflection point is the financial sector. Typically, when you get to the end of an economic expansion, the banks and the financial sector is way over leveraged. Typically, the banks are funding in the wholesale markets. They're buying hot money to fund loan demand, and so when you get the rise in interest rates, they get squeezed, and so on and so forth. And that creates the pullback of credit, which then triggers the downturn. The interesting thing this time is that the financial sector is deleveraged over the last 10 years. They're funding almost none in hot money. They're almost entirely funded with core deposits, plenty of core deposits, and they're not over leveraged. And so the financial system, the banking system in particular, is really in a situation that it can actually provide the liquidity that the economy needs, and it's not in a position to pull back that liquidity like it normally would. And so the dynamics of it tightening this time are somewhat different than they would typically be. So we're right at that threshold. It could go one way or the other.
And so what's your best guess?
I think our best guess is that we will get a global slowdown. We've gotten one. We think it'll continue. Because you don't have that latent pullback of leverage in the financial system, you probably won't get the air pocket effect. And so more than likely you'll get below potential growth, but you might get stuck there. Because the ability of central banks to stimulate on the backside of that is limited. I mean, basically, what you got 0, 2, 3% rates. No room to cut rates really, and probably the area of vulnerability is the business sector, because the business sector has been pretty strong in terms of its spending and technology, and the other area of vulnerability is what's really priced into financial markets. When you look at the earnings growth that's priced into the U.S. equity market, at the peak it was about 6.5% earnings growth, kind of ad infinitum. That's down some to 4.8. Tech sector's gone from 9 to 7% growth discounted, but still you're discounting 4.8% growth way, permanently, and yet profit margins are at secular highs. And from a secular standpoint, you've got a whole series of forces that are turning against corporations and profit margins. And so probably your bigger risk is actually in the financial markets than in the real economy. And the real economy is more likely to kind of get stuck at a subpar growth, kind of chronic slow growth with low interest rates, as opposed to like a sharp dip.
And so for equity markets, we've had about a 10% sell-off. People seem incredibly worried about that, as though it wasn't predictable or expected despite the run that we've had. What's most likely there? Let's say the economy gets stuck. Let's say the classic cycle continues.
Well, with the markets, what always matters is what happens in relation to what's discounted. And what's discounted is somewhat different across countries. In the United States, pretty optimistic earnings growth is priced in. And so if you were to go into that sort of sluggish, slow growth, chronic slow growth environment, highly likely that earnings would fall short of what's priced in. Adding to that pressure is that there's a decent amount of embedded expenses. In other words, companies have essentially, to some extent, extrapolated the good times forward in terms of their expense base. So there's some operating leverage there that if there's a slowdown in growth and top line revenue growth, that it would have a more magnified effect on the bottom line. And so, earnings in the U.S. are likely to underperform what's priced in. On the other hand, when you look at Europe, Japan, emerging economies, there's still a decent risk premium priced in relative to bonds, partly because bonds are so bad. But, so it's really what transpires relative to what's priced in.
So what should I brace for in my personal account? Down 30%, 50%? Or do we just sort of move sideways from here?
The best thing is if you have diversification and
I
balance.
know that, but I need to prepare myself for the likely scenario. So what should I do?
You just need to be able to sleep a lot better and not worry about those things. I mean, literally, if you balance yourself out with a much more balanced asset allocation, it's like, you don't have to, you're going to have ups and downs, but they're not going to be big ups and downs.
Okay. So other thing Bridgewater's talked a lot about is the rise of populism. Mm-hmm. You've talked about this, is tax rates aren't going to fix things because the problem is jobs and income. How does this get resolved, most likely, based on your studies of history?
Probably with difficulty. It's a difficult set of situations that we're embedded into, and you add to that the amount of promises and debts that are out there and retirement systems that are underfunded. You're probably going to essentially have promises not kept. You're going to probably have monetization, of the fiat money promises that are out there. You're probably going to have you're not really likely to have kind of a sharp, kind of depression type environment, but kind of 20 years of ugliness, is kind of what it looks like to us.
Bob, thank you so much. Pleasure to have you.
Sorry to end on that note.
I was going to say, is there something better we can end on? End on something else. What is good about it?
Huh? Well, let's see. There's always opportunity somewhere. If you just understand how it works, there's always opportunity somewhere.
Great, thank you.
All right, good, Henry.
Good.